JC, you say it's time to actually short the S&P, and you look at a chart of stock versus bonds that leads you to that call. Walk us through this chart.
Sure. Well, I think that this particular ratio is relevant for all investors. For the last, this is basically stocks versus bonds. Okay. Where would you rather be? And for the last 2 years, bonds have been outperforming stocks. I believe if you look at the TLT, which is, one of the more liquid exchange-traded funds that tracks Treasury bonds over the last 2 years, without the dividends, it's up about 20%. Look at S&Ps in the same time frame, you're looking at about 11, 12%, depending on what day you use as a close. So I continue to see Treasuries outperforming stocks. So there are two ways to take advantage of this. If you're going to be in one or the other, I would obviously prefer bonds. And for, some more sophisticated traders, I think you can be long of bonds and short of stocks.
So basically, though, you see momentum towards bonds away from stocks and nothing changing that for the time being.
I see just more evidence that suggests that trend should continue.
And when people talk about like the Fed and that stuff, you just think that's complete nonsense and you should just completely ignore it.
I don't think that you should ignore it, Joe, and you laugh because you know how I feel. But for me personally, I'm a price guy. I'm about the market. And when you talk about the Fed, look at short-term yields just absolutely ripping. 1-year yields, 2-year yields hitting 5, 6-year highs, while the long end of the curve, look at, 30-year yields, and they're not budging. They're not going anywhere. So when you talk about ignore the Fed, it's not that we want to ignore the Fed. I do, but that's not for everybody. I think that the market, supply and demand, controls interest rates, and then the Fed follows along. Like I said, the short end of the curve continues to rip to new highs.
So when you look at that chart, do we see curve inversion soon? Is that what you're expecting when you take a look at the sell-off?
I got to tell you, I think so. So here we're looking at the 10-year yield minus the 2-year yield, and traditionally, the government pays you more money to hold for longer maturities, right? And when you're seeing the short end of the curve ripping and the long end of the curve not going anywhere, you're seeing that narrowing of the spread. So we're looking at a 10-year yield right around 2.2%. We're looking at a 2-year yield right just under 1%. So one minus the other, you're looking at about a little bit over 1.2. If that 1.2 breaks, and I think it does, I think next stop is inversion.
Wow. All right, a lot of people have Apple in their portfolios. It's been getting slammed a lot lately. I think it's down like 20% around there from its highs. Probably causing anxiety for folks. Where next on this one?
I think it's been a great short since February. I've been very vocal about it. In fact, last time I was on the show with you guys, we were talking about how if we broke that support throughout the summer, that was going to be a problem. That broke in August. So yes, I definitely think it's a problem. The uptrend line from the 2009 lows is now broken. It's been underperforming the S&P 500 since the spring. I think it's going back to the low 90s. I think you fade any strength, and it's still a short.
Which also moves into why you'd be short the S&P too, because Apple is such a big part.
Hard to imagine the market overall rallying without Apple.
Apple, absolutely. And then let's wrap it up with emerging market stocks. What are the charts telling you into 2016?
Right, so speaking of overhead supply, in the summer when Apple broke, so did emerging markets, right? And, this is nothing new. Emerging markets have been underperforming forever. As bad as the S&P 500 is, and we're talking about, staying short S&Ps, the S&P 500 is currently hitting 11-year highs relative to emerging markets. So that just speaks about the relative weakness in emerging. I think that continues. I think you continue to fade any strength in emerging markets. I think the only remedy here is probably time, and I think it's going to need a lot of it.